Oh, hello. I didn't see you there. I'm Scott Fox, lifelong insurance nerd. And today I want to ruin a very comfortable assumption. The one almost every professional services firm I talk to is carrying around without realizing it. We take you now to a law firm in Canoga Park. It's Wednesday morning at a 12-person law firm. The bookkeeper, Janet, a meticulous woman who has never made a wire transfer mistake, gets an email that looks like it's from the managing partner. Subject line, wire transfer needed today, vendor payment urgent. Janet reads the email, sees what looks like the partner's signature block, sees the vendor's invoice attached. She calls the bank, initiates a wire transfer for $85,000, and goes back to her coffee. 2 hours later, the partner walks in, asks Janet about a different matter. She mentions the wire. What wire? The partner had not sent the email. The signature block was a copy. The invoice was a forgery. The email had come from a domain one character different from the firm's actual domain, partnersmith/lawnet.com. Instead, it came from partnersmithlaw.net, and $85,000 was already on its way to a Money Mule account in Eastern Europe. The firm calls their cyber insurance broker expecting some bad news, but recoverable bad news. The broker pulls the policy and reads back a number they had never really paid attention to. The cyber limit policy has a $25,000 sublimit on social engineering fraud, not the $1 million for the main policy. $25,000. The remaining $60,000 is on the firm for one wire that was approved by an actual human staring at an actual screen. So here's the comfortable assumption almost every CPA, attorney, agency, and consulting firm is running on. And here's exactly where the cyber policy industry has been quietly walking back coverage for a decade. Let's get nerdy. Cyber insurance evolved with the threat. Coverage forms didn't always keep up. Now, let me translate that into plain language. The first cyber policies that came about 15 plus years ago were written for a different type of incident. Outside hackers breaking into networks. The risks insured were data breaches, ransomware, denial of service. The bad guy was always external, always technical, and the claim shape was always system intrusion. Then social engineering took over. Funds transfer fraud, business email compromise, vendor impersonation. These are not technical hacks. The bad guy sends a polite email to a real human. The real human approves a wire, and the money just walks out the front door. The bank sees a legitimate-looking authorized transfer. The firm sees an authorized employee doing what authorized employees do. The cyber policy looks at the loss and asks one question: was the system breached? If the answer is no, and in most social engineering cases, the answer is no, the email was just an external email that arrived legitimately and was acted on by an authorized employee. That means the main coverage doesn't trigger. What triggers instead is a sublimit, and the sublimit is almost always a tiny fraction of the main policy limit. The carriers know this. The brokers usually know this. The firms paying the premium often don't, because the policy says $1 million cyber liability limit on the front page, and $25,000 social engineering sublimit lives on page 40. Nerd tip: pull your cyber declarations page. Search the full document for the words social engineering, funds transfer fraud, computer fraud, and wire fraud. The dollar amounts next to those terms, not the headline policy limit on the front page, are what actually responds when an employee sends a wire on a spoofed instruction. So the 4 buckets of coverage. The 4 buckets carriers use and which one you're actually buying. When a claims adjuster looks at a wire fraud claim, they're sorting it into one of these 4 buckets. Knowing the buckets is half the battle. Bucket 1 is computer fraud. This is the classic version. Somebody hacks into your computer and they use it to initiate a transfer. There was an actual digital intrusion. A traditional cyber policy responds, often at full limits. Bucket 2 is funds transfer fraud. Somebody fraudulently induces your bank to transfer money out of your account. The instruction came in through banking channels, a forged signature on a wire form, a hacked online banking session. The fraud is between the bad guy and the bank, not between the bad guy and your employee. Bucket 3 is social engineering fraud. Somebody tricks an authorized employee at your firm into sending the money. Exactly the Janet scenario. The employee was tricked. The wire was authorized by the firm just under false pretenses. This is the bucket that has the smallest sublimit on most policies. Bucket 4, sometimes called vendor impersonation, is a variant of social engineering specific to fake invoice or fake banking instructions from a fake vendor. And bucket 3 is the bucket the bad guys are using 90% of the time in 2026. Nerd tip: ask your broker for a coverage matrix that lists each of these 4 buckets: computer fraud, funds transfer fraud, social engineering fraud, vendor impersonation, with the dollar limit and any conditions for each. If they can't produce that inside of 1 day, it's a bad sign. Most cyber policies that do offer real social engineering coverage have a sneaky condition tucked into the language. Something along the lines of, coverage is contingent on the insured verifying any new wire instructions or any change in vendor banking information by direct telephone communication using a previously known phone number. In plain English, before you wire money to a new account or to a vendor whose account number has changed, somebody at your firm has to call the vendor at a number you already had on file, not a number from the email, and verify the wire is real and the account is correct. Now, that sounds like common sense, but it's also extremely easy to violate by accident. Janet got the email and called the bank to initiate the wire. The bank, not the supposed vendor. The verification condition wasn't met because the call was placed to the wrong party. I called somebody before sending the wire. That's compliance. The carrier reads the policy language strictly. The call has to be to the payee at a known number before the wire executes. This is the condition that most often turns a marginal claim into a full denial. The firm thinks they verified. The carrier reads the language and says, you didn't verify the right party. Nerd tip: print 1 sheet of paper and tape it next to the desk of whoever does your wires. 3 rules. 1. Any new wire on any change in banking instructions requires a phone call to the vendor at a known number, not a number from the email. 2. The call happens before the wire executes, not after. 3. The phone call is logged in writing in the wire file. 3 lines, $8 of laminating, $25,000. You do the math. When it comes to the amount of coverage you need, size matters. Let me walk through what real coverage looks like at different firm sizes, because the right answer is not the same for a 4-person agency and a 40-person firm. For a small firm, say 4 to 10 people, low to no wire volume, small operating accounts, a $250,000 social engineering sublimit on a $1 million main cyber policy is usually right. The premium difference between a $25,000 sublimit and a $250,000 sublimit is often just a couple $100 a year. For a mid-sized firm, 20 to 50 people, regular wire activity, vendor relationships in the 6 figures, you want $500,000 to $1 million social engineering limit. The premium delta is larger, but still small relative to a single wire fraud incident, which according to the FBI currently averages around $130,000. For larger firms or firms that handle client funds, like IOLTA accounts at law firms, escrow accounts at certain consulting practices, you want the social engineering limit to match the main cyber limit, plus separate client funds coverage extension that responds when the loss is from a client trust account, not the firm's operating account. Nerd tip: whatever your wire fraud sublimit is today, ask your broker for the premium quote to bring it to 10 times that limit. The number is almost always smaller than you'd guess. So the last part is things your policy can't fix. This next piece of advice isn't really insurance advice. The best cyber liability policy in the world is a financial backstop, not a prevention plan. Every wire fraud loss starts with a process gap, and almost all of them can be closed without spending another dime on coverage. 3 rules posted somewhere everyone in your firm can see will prevent the great majority of social engineering losses. Rule 1: any wire above a defined threshold requires 2-person approval. Rule 2: any change in vendor banking information triggers a verification phone call before the next payment. Rule 3: any wire request that arrives by email gets a 5-minute hold and a callback to the supposed sender at a known number, even when the email looks legitimate. If your firm runs those 3 rules, the social engineering exposure drops dramatically, and the cyber policy becomes a true backstop for the truly novel attack instead of a band-aid for process lapses. Nerd tip: run a tabletop exercise once a year. Send your bookkeeper a fake urgent wire email from a domain that looks like yours. See what happens. If they wire the money, you have a process problem, and the policy is your only defense. If they make the verification call, you have a process that works, and the policy is just there for the edge cases. Bottom line: professional services firms get socially engineered. That's not the question. The question is whether the policy you've been paying premiums into is built for the threat that's actually attacking your industry, humans tricking humans, through a real inbox, or whether it was built for the older threat of outside hackers breaching networks. Pull your cyber declarations page. Find the social engineering sublimit. If it's $25,000 or $50,000 or $100,000 on a $1 million headline policy, that is the gap that turns an incident into a survivable inconvenience or into a balance sheet catastrophe. If you want a second set of eyes on your firm's cyber program, the social engineering sublimit, the funds transfer fraud language, the verification conditions, the wire process discipline, book a 15-minute coverage review with me. Links in the description. I'll read your policy the way a claims adjuster reads a claim, and you'll walk away knowing exactly which buckets are full, which are half full, and which are bone dry. No quote, no sales pitch, Just the read. Thanks for watching, and as always, stay nerdy, my friends.